Stocks tumbled today on Wall Street. The slide driven by the second biggest bank failure in U.S. history.
Alarm outside headquarters of Silicon Valley Bank in Santa Clara, California.
California regulators have just shut it down in what's become the largest failure since the financial crisis.
Where upset customers were lined up trying to get answers. Many are now taking their cash reserves out of banks. SVB also had some other assets lose value, which caused even more strain on their bottom line.
We're probably talking tens of thousands of clients. And, we're talking CFOs and CEOs of startups that need to pay their people, that need to invest in technology, that won't be able to scale out their businesses or to last through what could potentially become a recession. And so this cash is actually critical. For any startup, cash is really a lifeline. And so this bodes very badly for the region's small businesses.
The real problem is the bond market's crashing. And the bond market is systemic, as you know. I mean, I'm concerned about IRAs, pension plans, and all that. So this is more than I'm concerned, should I say. And then, thank you for all these years letting me come on your program and say, buy silver, buy gold. Because when I first started coming on, I think this was $3 and this was $50. And now it's $2,000. Now, the thing that I see is that the Fed and the FDIC are signaling hyperinflation, which makes gold and silver even better because this thing here is trash. They're going to print more and more of this fake money. And that's what the Fed and the FDIC is signaling. We're going to print as much of this as possible to keep the crash from accelerating. But they're the guys who are causing it.
Was when one big bank and a couple of others started to fail, could not pay their depositors, could not actually pay up what they owed. They were closed, and regulators had to move in very, very quickly. But we ended up with a financial crisis because one big banking card easily starts tipping over other cards. It's a house of cards. Now, we don't know yet about contagion. What we do know is that this bank was obviously overextended, and this is related to the Fed because as interest rates went up, and this bank was lending to a lot of startups, this bank simply could not handle it. I think that this is the biggest economic news today. It is not this jobs report. The jobs report was good, and it's kind of signals to me a soft landing. But I think that in terms of what the Fed is going to do, this bank implosion, this potential contagion may reverse Jerome Powell's direction. It may lead to, instead of a half a point increase at the March meeting, it may lead to no increase at all. In fact, it's even conceivable that interest rates start dropping out of a fear that we're going to be in deep trouble.
You have advocated for the Fed to stop increasing the interest rate. Why? Before this issue with Silicon Valley Bank.
Simply because I don't see any wage price inflation. Wages, according to Jerome Powell, are pushing up prices. Well, that's simply not the case. Look at today's report, for example. We're seeing the smallest wage increase in over a year. Prices continue to rise. That is absolutely true. But wages are not pushing them up. It's not that workers are doing so wonderfully well. But what's pushing up many prices domestically is big companies that want to increase their profit margins. And so they have monopolies or near monopolies, oligopolies. They are using the opportunity, using inflation as an excuse to put up their prices. So this is at its bottom here. It really is an antitrust monopolization issue. It is not a Fed interest rate problem.
So you suggest that the Fed should stop increasing the interest rate, but if that is the only tool they have, I imagine you're going to correct that assumption, but if that's the only tool they have to try to bring it back down to the 2% rate, that goal, then what else can they do to try to tame inflation, if not increase the interest rate?
Well, first of all, let me just say it's not clear that they have to do anything else. Inflation is starting to come down. Now, we'll find out more Tuesday when the inflation report, the consumer price increase report, inflation report will be coming out. But as of what we know now, inflation is slowing slightly. And the key here is the direction. If inflation were increasing, that would be one thing. But if inflation is starting to slow down, if we're seeing it going in the right direction, then it's not clear that the Fed has got to keep raising interest rates and risking a recession that's going to hurt everybody.